On Sunday, it will be 4 weeks that I sent out the original video warning about an upcoming salami crash in financial markets. That was on February 23rd. 4 days later, on February 27th, I followed up with another video. I called it More Pain, outlining the economic consequences of this annoying coronavirus. Unfortunately, my worst fears have become true, and it is playing out exactly as I was afraid it would. And prices since then have dropped more than 30%, and there's a lot of people out there who are hurting. And today's presentation will differ from the ones that I've done in the past, because I believe people need help out there. But I am not a financial advisor, and I want to make this crystal clear. I will simply outline what my next big trade is going to be. And there is 3 different ways to play it. And you have to ask yourself, and obviously your financial advisor, if this is something that is even suited for you. So please be aware of the risks. And at the end of the video, there's a disclaimer. Please pay attention to it. So, but let's get to the content of the video, because what we will see is a huge rescue package. It's going to be the biggest bailout we have yet seen, and it is tough to put a number on it. I believe it will be somewhere in the neighborhood of $2 to $4 trillion, and we are just talking about the US here, but in the end it will be global. Every major economy will have to bail out itself pretty much. So governments and central banks will work together. The central bank will print the money because there's simply not enough tax revenue available, and money will be handed out left and right. There will be helicopter money and there will be money everywhere, but it is necessary because we have never, at least not since I've been around, and there's probably nobody alive who has ever experienced something quite like this. Because the most important thing right now is that we slow down the spread of that virus, and that means we have to pretty much shut down the economy. So it is not that just our kids have to stay home because they can't go to school. It is also we cannot go to work, because that is where people get infected. Then they come home and then they infect their families, and we have to stop that. So how do the people survive if they do not have payroll because they are not going to work? How do the businesses survive if they don't have any income because nobody is coming into the store anymore? So there is only one solution, and that is a massive rescue package. And this time around, we have to bail out everybody. We have to bail out the worker who is not getting paid anymore, and we have to bail out the business that sees no demand for their products anymore or can't even produce the product. So it will be huge, and it is we have no choice, right? If we didn't do it, we would be in the worst economic scenario that one can imagine, because 20-30% of the economy would go bust, and then we had high unemployment. I mean, I don't even want to go there. Government won't go there. They will bail them out. That is just, at least that is my opinion. I believe they understand the severity of the moment and they will act. What I don't know is, do they act on Monday, or are they stupid enough to wait till Tuesday or Wednesday or Thursday or even next week? It's possible, because these are still politicians. But in the end, the market will force them to get it done. And if the package is not big enough, the market will continue to drop and drop and drop until it is big enough. So it will happen. At least that is what I believe. So what are the consequences of a massive bailout? If there is not enough money that a government takes in from taxes, there is only one other option, and that is to print that money. So if only one country were to print the money, it would simply inflate that currency, so the value of that currency will go down. relative to another currency. But when it is a global phenomenon, then all currencies are going down at the same time. And when we are all staying at home and not spending money, then it is almost impossible for a company to hike prices, except maybe for a can of soup and some TP. So what we will see is deflation, because the companies that are still trying to sell stuff, the only way to get something across the table, across the counter, is if they lower prices. So short term, we will see deflation. All of this hunkering down at home, will have a massive impact on mass psychology. People will not be happy that they have to stay at the house and they cannot go outside, or only for doing essential activities. But this will pass at some point. This annoying virus will peak at some point, and when it does, people will start leaving their house again, and all of a sudden this psychology will flip-flop and they will become happy campers. What do happy campers do? They spend money, and that is when we will see inflation. And since no central bank will hike interest rates into a recovery after a global pandemic, this is the perfect cocktail for gold prices to go higher, because what they need to go higher is falling real interest rates. And real interest rates are calculated by taking the level of interest rates and then subtracting the level of inflation. So what we need for gold to do well is interest rates to remain low and inflation to go higher. And that is exactly what will happen once that coronavirus has peaked. But the market will anticipate it. So gold will not wait for that before it takes off. And I expect that the price of gold will take off, or starting to take off, very soon. So let's get at it. What is the trade? Is it gold miners? I mean, we have seen how GDX and GDXJ have gotten destroyed the last few weeks. They have underperformed the price of gold big time, and they have been so violently volatile. I have never seen anything in my life. And since I want to put on an options trade, I do not want to deal with gold miners, because the implied volatility, how expensive options on gold miners are, simply doesn't make sense for me to put on a trade in gold miners. So I don't want to do that. So I can X this one out. Also, silver has underperformed big time out there. Implied volatility for silver is also way higher, and it has underperformed gold. So I also want to X that one out. But when I look at gold itself, I believe this year is the one. And if I knew how to do it, and I'm not a graphic kind of guy, I mean, it's like design is not my forte, and you will see that later on in a couple of slides. I tried to do some coloring there. It's like, it's painful for me. But if I knew how to do it, I would put a check mark here, because I believe we have to focus on GLD, the ETF for gold, because it has performed the best, and the implied volatility, which is a fancy way of saying how expensive an option is the cheapest out of all of those. So I believe the risk reward, putting an options trade on GLD, is the best, and that is why I will do just that. And earlier I mentioned that I will outline 3 different ways of trading this: a smart way, a reckless way, and a Mickey Mouse way. And I wasn't sure if I should call it Mickey Mouse or simply stupid, but it is something in between. And the smart way is the way I would play it, and I'm not insinuating that I'm the smart guy. I'm just saying that I believe this one here makes the most sense, and that is a call spread, a 137, 142 call spread in GLD. And I want to give myself about a month until expiration. So April 17 is the expiration. I will try to buy this call spread for as close as I can to 250, because 250 is a beautiful number, because it will imply that I can make a profit of potentially 100%, because call spread will always, the max profit you can achieve in a call spread is always the difference of the two strike prices. So 142 minus 137 is 5. So I want to try to get this for 250 so that my potential profit is 100%. And how a call spread works is you buy the lower strike. So we are buying the 137 call, and then we are selling the 142 call. And together it is a vertical call spread. And we do that for two reasons. To improve the odds that we are not losing money, and to lower the costs of the trade. But because we are selling an option against it, we are capping our upside, and that is why our profit potential will never be higher than 100%. So if we were to get it at 250, for example, that spread cannot be worth more than $5. So our upside is capped at 100%, but it has two advantages, because we will get in cheaper than if we were just buying the 137 call outright. And it also means that our 100% profit target is not that far away. Today, GLD closed at 141 and a little something. So if gold does not go down from here, we will make money. And if it just goes up a little bit, we will make 100% in profit or double our money. I believe that risk reward is excellent, knowing or believing to know that there will be a massive bailout coming before that expiration. And we have 4 weeks to be right here. And Congress is stupid, but I don't believe they are as stupid that it will take them more than 4 weeks. So I believe this makes here a lot of sense. And I mentioned earlier that I tried to do some graphics here, and I'm really proud of it. So please do not make fun of me how ridiculous this looks. But what I'm really liking about this trade is that our break even is 139.50. So it is below where price of GLD is currently at. So that is excellent. And our max profit, which is a double, is just 142. So we don't need gold to put on a massive rally to get our max profit. All what we need is that price goes a little higher than it currently is, and we will bank 100% profit within a month. I do believe that risk reward here is excellent, and that is why I call this one the smart way to play it. But we also have a reckless way to play it, and if I want to give it a little more slack, I would call it the aggressive way of playing it. We are still picking the April 17 expiration, but we pimp it up by $10. Instead of taking the 137, 142 call spread, we are going with 147, 152. And we only want to pay at most $1 for it, since this is also a $5 spread. 152 minus 147 is $5. We want to pay no more than a fifth of that price, which means $1. And that then implies that our max profit, and if I could draw another arrow here, I would do that right now. That means our max profit is 400% or 5 times our money. And what we would need to do to put on a call spread is we buy the 147 call and we sell the 152 call. And I know you're all excited to see my beautiful graphic for this one. And here the break even is a lot higher. That's why this one is the reckless one. We need gold to rally some $80 or so for us to break even. 148 would be our break even price. If we get above 152, we would reach our max profit of 400% or 5 times our money. So anything above this here, all this. And if I knew how to color that in a different color, I would have done that. But I was, my patience was, I mean, this is as good as it gets here. So this here is the area where you get the max profit of 5 times your money. But it is obviously a lot riskier, because if price stays below this here, this trade will be a loser, and you will lose everything that you put in to that options trade. So please be aware of that. This is an aggressive, it is a reckless play. I do believe in this sense, in this scenario, it actually does make sense, because I believe the odds are better than 20%. So if you get 5 times your money, right? If we assume the market were fair, we would say that there is a 20% chance that this could actually happen. Think about a roulette payout. I believe the odds are higher than 20% that this is going to pay out the way that we go above 152. But it is still a very aggressive way of playing this, and you should only put that trade on if you can afford losing all of your capital. This is still a gamble. And this here is my favorite category, at least by name, and that is the Mickey Mouse category, or the stupid way of playing it. We are sticking with the April 17 expiration. Here we are buying a 135 called Naked, and at the close prices were between 810 and 835 bid and ask. So these options, these calls are in the money, and our profit is unlimited, but it depends what price is going to do. And I also have a beautiful graphic for this one. I mean, look at this. Our break even here is in between the two other ways of playing it. The original, the smart way, the way I labeled it, had a break even of 139.5. This break even here is 143.2. That is one disadvantage. The other disadvantage is, in order to double the money, we only needed 142. We needed this level here in the smart trade to double our money. In order for us to double our money in this trade, we need something close to 152 bucks for GLD. It depends when we get filled. If we were to get it at 820, our double, our price would be 151.40. So somewhere here we would double our money, and that is why I like the smart way of having a conservative call spread. 137, 142 call spread, I believe, is the best way to play it. But this one could work as well. Your break even is higher. The odds that you lose all of your capital are relatively slim, because price would have to drop below 135 to lose all of your money. That is the only upside of this Mickey Mouse way of trading it, that your total loss is lower than in any other. Your upside is potentially unlimited, but it is more like academic, because you're paying $8.20, and that, at least that is what I'm assuming here. So every $8.20 you double your money. So if it goes up 8.20 and then another 8.20, then you triple it. So it is relatively slow, and it is inferior to both of the other plays, because at 152 you already make 5 times your money with the reckless way of playing it, which is here. To make 5 times your money by simply buying this option, I mean, price would have to go through the roof. The odds of that happening are very slim. So this is only if you have no other way of playing it. So, but the other two I much prefer. If you want more information about it, you can find it on quantyeti.com. You can also find those videos that I referenced at the beginning, the salami crash video that I put out on February 23rd, the more pain video that I put out on February 27th. But I also told you that I would show you a disclaimer, because what I'm trying to do is I try to provide as much value as I can, but I also understand that there is risk. I do not know the future. So if I tell you what I will do, it doesn't mean that life will actually happen that way. That price will do what I am suggesting. So I have to protect myself. Otherwise, I cannot bring out this content. So please take a look at this disclaimer and don't sue me if it doesn't work out.